Okay, so trying to keep up with blockchains, DeFi, it feels like you blink and something new pops up, right?
Oh, absolutely. It's moving incredibly fast.
And underneath it all, you absolutely need reliable data. It's like the bedrock,
Exactly. Without good data, smart contracts are kind of flying blind.
which is where blockchain oracles come in. They're the bridge, basically. Getting real-world info onto the chain makes DeFi actually work.
Yeah, they're essential. You can't just trust one single source in a decentralized world. It defeats the purpose. Oracle solved that trust problem, securely getting outside data in.
Right. And that brings us neatly to today's focus, RedStone. The ticker is RAD. You, our listener, actually pointed us towards this one. We dug into the materials you sent, dated around February 2025, and, well, it looks pretty interesting.
It does. The docs give a really good snapshot of where they were positioning themselves early last year.
So our mission today,
Hmm.
let's unpack RedStone.
Yeah.
What is it? What makes it tick differently than other oracles? And, why should someone interested in DeFi or Web3 care?
Sounds like a plan. Let's dive in.
Okay, so fundamentally, RedStone is a blockchain oracle provider. No surprise there.
Right. The core job is delivering data.
But the materials stress things like speed, gas efficiency, being tamper-proof, and built for cross-chain from the ground up.
And their big goal, it seems, is to be the go-to data source for everything, any use case, any blockchain. That's ambitious.
It really is. They talk about this modular oracle technology built by builders for builders. What does that signal to you?
Well, by builders for builders usually means they're focused on practicality. They understand what developers actually need. It's not just about dumping data. It's about making it easy to integrate and use.
Uh-huh. And they mention different ways to get the data, push, pull, even custom models.
Exactly. That flexibility is key. Push is good for things like lending, needing constant updates. Pull is better for maybe derivatives or faster chains where you only fetch data when needed. Saves gas.
And this is any asset, any chain, any use case mantra. That's broad.
It's super broad. It suggests they're not just thinking about standard crypto prices, but maybe, real-world assets, NFTs, even more exotic stuff down the line.
And looking at their highlights from back then, they seem to have walked the walk. They were apparently the first oracle to support liquid restaking tokens, LRTs, back in 2024.
Yeah, and got adopted by big names like EtherFi, Renzo, Kelp DAO. Being first with a new asset class like LRTs is a big deal.
Why is that so impactful, getting there first?
It shows they're agile, right? They can adapt quickly to new trends in DeFi. Plus, it gives them a first-mover advantage with protocols building around those new assets.
Makes sense. And they did it again with yield-bearing stablecoins, apparently first to support those two, working with Athena Labs and others.
Right, another emerging area. It paints a picture of a team that's really plugged into where DeFi is heading.
The innovation didn't stop there either. First, BTC staking Oracle, adopted by several projects, and then this AI thing, Clara, an AI agents communication framework.
Yeah, the Clara mention is interesting. It hints they might be thinking beyond just delivering price data. Maybe facilitated communication between different smart contracts or AI agents on chain. That could open up some really new possibilities.
Definitely something to watch. Another point that jumped out was them being the oracle of choice for a bunch of new chain launches in 24 and 25. Kraken's Inc., L2, Unichain, Movement, Berachain.
That's a strong signal. New chains need reliable oracles from day one. Being chosen repeatedly suggests a high level of trust in their tech and reliability.
And becoming the first top oracle with an AVS and actively validated service in 2025. We'll get more into AVS later, but that sounds significant for security.
Oh, absolutely. Yeah. Leveraging eigenlayer security through an AVS is a major development in the Oracle space. Big security boost.
They also got added to Spark Protocol's Oracle setup, another big lending platform.
Right. Integration with major players like Spark is crucial validation.
And the growth numbers they reported for 2024, wow, over 500% user growth, and get this, over 6,000% growth in total value secured TVS.
Whoa. Okay, that's explosive growth. 6,000% TVS increase in a year. That suggests whatever they were securing data for scaled massively, and users were flocking to them. Strong market fit, clearly.
And the sheer breadth supporting 78 blockchains and over 12,250 unique assets. More than any other oracle mentioned in the docs.
That scale is impressive. It speaks to their technical ability to integrate across a very fragmented ecosystem. And again, supporting both push and pull models makes them versatile.
Right. You explained push and pull earlier. Push for constant updates like lending, pull for on-demand like perps or fast chains.
Exactly. Catering to both covers a much wider range of potential customers and use cases.
Okay, let's get a bit more technical. This modular innovation idea keeps coming up. One part is deep price discovery. What's that about? Sourcing from CEXs and DESIXs.
Yeah, so instead of just relying on, say, Binance or Coinbase, they also pull price data directly from decentralized exchanges like Uniswap. The idea is to get a more complete, robust picture of an asset's price.
What's the benefit? More accuracy.
More accuracy, potentially, especially for assets mainly traded on DEXs, and better resilience. If one source goes down or gives a weird price, you have others to balance it out. Less risk of manipulation.
Makes sense. They also mention specific products for quant needs, like special feeds for LSTs, LRTs, and proof of reserve data, tailoring things.
Right. These aren't just simple price feeds. LSTs and LRTs have complexities, like underlying staking yields. Proof of reserve for things like wrapped or staked Bitcoin needs very specific, verifiable data. It shows they understand the nuances of these newer DeFi instruments.
And this modularity seems to be the key enabler for all this adaptability. Supporting AVS, something called OEV.
Oracle extractable value, yeah.
Yeah.
Complex topic.
Maybe for another time. But supporting all that, plus low latency feeds, how does being modular help them do all that?
Think of it like building with Lego bricks. Their system isn't one giant monolithic thing. It's made of distinct parts or modules. So if they want to add support for a new security mechanism like an AVS or develop super fast feeds, they can potentially build or upgrade just that specific module without having to rebuild the entire system.
Ah, okay. So it makes them more agile, faster to adapt?
Exactly. Much more flexible and quicker to innovate or integrate new tech compared to a less modular design.
Now, security. Hugely important for oracles. They lean heavily on using eigenlayer AVS, mentioning potential $14 billion in economic security. Can you break down why using eigenlayer is such a big deal here?
Sure. So eigenlayer-less Ethereum stakers reuse their staked ETH to secure other protocols called AVSs. By becoming an AVS, RedStone essentially borrows the economic security of potentially billions of dollars worth of staked ETH.
So it makes it incredibly expensive to attack or manipulate RedStone's data.
Precisely. An attacker would need to overcome a huge chunk of that shared security, making attacks economically infeasible, or at least extremely costly. It's a powerful way to boost trust and decentralize the Oracle's security.
Got it. The docs then break down their system into 4 main modules. First, the sourcing module, collecting data. They list over 180 sources. Binance, Uniswap, CoinMarketCap. Why so many?
Redundancy and accuracy. More sources mean you're less reliant on any single one. It helps smooth out anomalies and gives a more reliable aggregate price or data point. It's about robustness.
Okay, Module 2, the data distribution layer, or DDL, described as a low-latency intermediary. So data comes in, sits here briefly, then goes out.
Kind of, yeah. It's like a staging area. It decouples the sourcing from the delivery. This layer is optimized for speed and efficiency, making sure data is ready to be sent quickly to any destination chain that needs it. Helps with scalability, too.
Interesting. Third, the data relaying module. This sounds clever, embedding data into user transaction traces to get it on-chain.
Yeah, this is one of their key innovations, often called the RedStone core model. Instead of the Oracle pushing every update on-chain itself, which costs gas, they package the needed data, sign it, and let the user's transaction carry it onto the blockchain when they interact with a dApp.
Ah, so it sort of hitchhikes on a transaction that was happening anyway.
Exactly. The data gets verified on-chain using the signature, but it avoids the need for a separate Oracle transaction for every price update, potentially saving a lot on gas fees, especially on busy networks.
Clever. And the final piece, the data consumption module. This is on the receiving blockchain, verifying the data.
Right. Once the data arrives on-chain, whether via the relaying module or another method like push, this module unpacks it, crucially verifies the cryptographic signature from the data provider.
Making sure it hasn't been tampered with.
Correct. And it performs sanity checks, like does this price look reasonable compared to the last one? Is it within expected bounds? It's the final quality control step before a smart contract uses the data.
And those cryptographic signatures you mentioned, they're key throughout.
Absolutely fundamental. They provide proof of origin and integrity. You can mathematically verify that the data came from a trusted provider and hasn't been altered. It's core to the security model.
So wrapping up the tech side, this whole modular setup really seems to be their superpower. Lets them add assets, chains, reduce latency, boost security by swapping parts.
That definitely seems to be the core argument, yes. Agility, scalability, future-proofing. That's the promise of modularity.
Okay, let's talk about the token, RED. The materials say it has 2 main jobs, staking and payment. Explain the staking part.
Sure. So Data providers, the entities actually sourcing and signing the data, have to stake RAD tokens. It's like collateral or
Okay.
security deposit. If they provide bad data, their staked RAD can be slashed, penalized.
Skin in the game.
Exactly. It aligns their incentives with providing accurate data. Plus, regular RAD holders can also apparently stake their tokens, likely via the eigenlayer AVS integration we discussed, to add even more security and earn rewards.
And it was even meant to be a liquid restake token, an LRT, at launch.
Yeah, that's interesting. It means stakers could potentially get a liquid token representing their staked RAD, which they could then use elsewhere in DeFi while still securing the network. Adds capital efficiency.
And the second use, payment currency.
Right. Protocols or users who consume RedStone's data pay fees. But instead of paying in HORAD, it seems they pay in major tokens like ETH, Bitcoin, stablecoins.
Okay.
And those fees then get distributed to the RED stakers. So staking RAID allows you to earn a share of the network's revenue paid in other valuable assets.
So holding and staking RAD gives you a claim on the fees generated by the Oracle service? That makes sense as an economic incentive.
Yeah, it creates a direct link between the success and usage of the Oracle network and the value accrual to the token holders.
The docs from Feb 25 gave some token numbers too. Total supply, 1 billion RAD. Circulating supply at listing expected to be 280 million, so 28%.
Okay, standard metrics.
And specific mentions of 40 million RAD on Binance pre-market and another 40 million for the Binance launch pool, which was starting right around then.
Right, those details give context on the initial distribution and potential early market dynamics. Launch pool allocations often generate buzz and initial liquidity.
They also mentioned raising nearly $23 million USD across 3 private sales. What does that kind of funding signal?
Raising that amount, especially over multiple rounds, usually indicates strong backing from venture capital and other investors. It suggests they saw significant potential in the team, the tech, and the market opportunity. It provides runway for development and growth.
Okay, let's shift to their roadmap. Looking back from Feb 25, they seem to have hit quite a few milestones in the year prior. Partnerships like Lido, Lombard, Sonic, launching Guard, Clara, the AVS, supporting chains like Berachain and Story.
Yeah, that's a solid track record of execution. Delivering on partnerships, launching new features like the AVS, integrating with new ecosystems, it shows they could turn plans into reality.
And what were they looking at next according to that roadmap? Q1 to Q3 2025.
Q1 had a focus on restaking research, specifically mentioning Bitcoin staking via Babylon, which is interesting. Also looking into optimizing capital efficiency through that Oracle Extractable Value, OEV, concept.
OEV again. Briefly, why is that interesting for oracles?
Well, it's about how the timing and inclusion of Oracle updates can create profit opportunities, maybe through arbitrage or liquidations. Understanding and potentially harnessing or mitigating OEV is becoming important as DeFi gets more sophisticated. It's complex stuff.
Gotcha. Then Q2 plans included bespoke products for real-world assets, RWAs, and proof of reserve, or specifically targeting institutions and using zero-knowledge proofs.
Right. That's a big push towards bridging TradFi and DeFi. Using ZK proofs is key there.
Why ZK specifically for institutions? Privacy.
Exactly. Institutions often need confidentiality. ZK proofs allow you to verify something, like reserves backing a stablecoin or details of an RWA, without revealing all the underlying sensitive data. It's crucial for compliance and privacy needs.
Also in Q2, exploring more AI stuff with Clara and developing RedStone Lightning for near-zero latency feeds. Sounds like speed was a big focus.
Definitely. Ultra-low latency is critical for certain applications, like high-frequency trading or some types of derivatives. Pushing the boundaries on speed is a competitive necessity.
And Q3 was about a bespoke offering for seamless onboarding of corporate and institutional players, doubling down on that TradFi bridge.
Seems like a major strategic direction for them, making it easy for big traditional players to use their Oracle services and participate in DeFi. That requires meeting high standards for reliability, security, compliance, and support.
Okay, finally, let's talk partnerships and integrations as of Feb 25. The list is pretty long and impressive. Eigenlayer, Unichain, Afave, Spark, Pendle, Berachain, Story, Athena, Movement, EtherFi, Morpho, Hyperliquid.
Wow, yeah, that's a significant ecosystem they'd built by then,
Yeah.
covering a lot of ground.
What does that breadth tell you?
It tells you they weren't just building tech in isolation. They were actively integrating across many different parts of DeFi and Web3. Each partnership represents a validation and a real-world use case.
Like Eigenlayer, first major Oracle secured by restaking, you said. That's a unique selling point.
Huge differentiator, yeah. Unichain, official Oracle partner for new L2s. Avi and Spark major lending platforms, Pendle using their feeds for LRTs, Chain deeply embedded in that ecosystem, Story powering decentralized IP infra, Athena supporting their stablecoin, Movement another L2 launch partner, EtherFi big LRT provider allocating restaked assets to their AVS, Morpho customizable lending, Hyperliquid exclusive Oracle for parts of their platform.
It really covers the spectrum, doesn't it? From core infrastructure to specific DeFi applications.
Absolutely. It shows adaptability and broad market acceptance. They seem to have convinced a lot of different projects that their data solutions were reliable and valuable.
Okay, so let's try and wrap this up. Key takeaways from this deep dive into RedStone, based on that Feb 25 snapshot. It's all about modularity, cross-chain support, handling different data models like push and pull.
A big focus on security, especially leveraging eigenlayer AVS and staking.
And this rapidly growing list of integrations and partnerships across the space. They weren't just aiming to be an oracle, but maybe the foundational data layer.
Yeah, that seems to be the ambition. The modular design feels like their core strategic bet, allowing them to stay flexible and integrate new things quickly. The security angle with eigenlayer is powerful, and the partnerships show real traction.
So final thought for you, our listener, to chew on. Given RedStone's focus on modularity, speed, security, and embracing things like restaking and even AI frameworks like Clara, what kinds of new things might become possible in DeFi? What happens when Oracle data gets even faster, more secure, more versatile?
It's a great question. Does it unlock new types of financial products, more complex automated strategies, better bridges to real-world data and assets? Definitely something to think about.
Indeed. If you want to dig deeper into RedStone yourself, the materials mentioned their website, docs, and community channels. That'd be the place to continue exploring.
Good suggestion. Always best to check the source and see how things have evolved since early 2025 too.